Good afternoon, everybody, and welcome back. I have the pleasure of moderating panel 2 of today with the title Geoeconomic Fragmentation, Drivers, Dynamics and Global Consequences. My name is Mette from Sicard. I'm a senior advisor to the Danish Central Bank. And as I said, I have the pleasure of moderating this very distinguished panel that have gathered here today. Geoeconomic fragmentation has, I would say, over a relatively short period of time, moved from the periphery into policy discussions and is today at the core of macroeconomic and monetary policy analysis. What we are observing at the moment is not only a series of geopolitical shocks, some would say shift, I say shocks, but it's potentially also a more fundamental shift in the structure of global economy, one that would affect trade, integration, supply conditions, financial linkages, as was discussed among others in panel 1, and ultimately, of course, the transmission of monetary policy. And for central banks, that raises a number of first-order questions. And I will not go through all the questions, but I think one of the things that the press and we as central bankers and research and so forth are grappling with at the moment is, how should central bank frameworks and communication evolve in response to greater uncertainty about the economic fundamentals? The distinguished panel we have here today brings together quite complementary perspectives on the drivers and their dynamics and the consequences of geoeconomic fragmentation. As you saw with the first panel we had today, there will be time for you to ask questions if you want to. And I really hope that all of you, or well, perhaps not all of you, because we would not have time for that, but many of you would take the floor and contribute to this important discussion. Now, let me quickly introduce our panelists. Gernot Müller, let me start with you. You hold the chair of the International Macroeconomics and Finance at the University of Tübingen and is, among many other things, also a research fellow at the CEBRA. Our second panelist is Loretta. You are adjunct full professor of finance at the Wharton School, University of Pennsylvania, and is, among others, a senior scholar at the Griswold Center at Princeton. And not last but least, you're also former president and CEO of the Federal Reserve Bank of Cleveland. Our final panelist is Luis Céspedes. Luis is member of the board of the Central Bank of Chile, and you have very extensive experience in macroeconomic policy, both as a central banker, but I also learned that you're the former Minister of Economy at Chile. So I really want personally to thank you all for taking the time to join us here in Copenhagen. All of you will give a presentation, and then, as I said before, I will open the floor for questions. But Gernot, may I ask you to take the floor as the first one? Thank you.
Thanks. Okay, so thanks for having me. I'm very excited to share some thoughts here on this important and timely topic, drivers, dynamics, and global consequences. So I guess I want to make 3 points related to geoeconomic fragmentation. A, it's rising. B, it's costly. And C, it's self-reinforcing. On the first, the rise, I look at a bunch of measures. Actually, I think it's less obvious in the data than you might think, but I will argue that by and large, if you look at this range of indicators, you could reasonably claim that since the early 2000s, you have an increase in geoeconomic fragmentation. Then on what do we know about the economic impact? I think this is still a very much open issue, with many exciting research being conducted at the time. So I think what we know for now, I will make the case, is that this is like a classic stagflationary shock, a supply shock, if there ever was one. Trade suffers. In which way, you know, is also still to be seen. And then because of trade slowing down and also because of other transmission channels, you get sizable spillovers to other countries which are not directly in, you know, the bilateral relationships you may consider. Okay, and lastly, I want to speculate more about the drivers of this fragmentation. Again, talking about the role of trade here and flag some, what some people call paradoxes. Okay, so let me start with these indicators. So I pulled like 4 indicators to try to devise a somewhat coherent picture or some, say, general pattern. So here, this is used a lot in the literature. I guess most of you have seen it. So here we're looking at voting patterns at the UN General Assembly. So this is a figure from a paper by Knut Niemann, a former PhD student of mine. Here he looks at this. In the left panel, you see the dispersion of votes at the UN. And then the intriguing pattern is that in the 70s, this was up. So a lot of disagreement, arguably, it came down as tensions calmed down globally. And then it starts to increase again in the early 2000s or so. Yeah. In the right panel, you see the distance to the US, also based on this voting behavior. And that is kind of the Cold War picture in a different way. So you have a lot of distance between Russia in blue and China in red to the US, and less distance in terms of voting between France and Canada on the one hand and the US on the other hand. And then you see some alignment here in terms of voting pattern. And then towards the end of the summer, which stops here into 2020, you see again these diverging patterns. And so some people argue that we are back to this Cold War level of fragmentation. So that's one measure. A second measure is what already Frederic showed. It's the Geopolitical Risk Index here by Caldara and Iacoviello. We all know it. It's based on newspaper readings and word counts. Here, you know, is there really a change at the current juncture? There has always been crisis, well-known crisis. This is data from '85. This is September 11. Now, if you look at the red line, this is a simple 12-month moving average. And then if you want, you see an increase since 2020, where this line is edging up. So you could argue that there is an increase in geopolitical risk events as Caldara and Iacoviello compile it. But this is, the baseline measure here is compiled at the country level. So you read these newspapers and then you look at geopolitical risk in certain countries. Yeah, when we talk about geoeconomic fragmentation, we have in mind probably something which is more dynamic, so bilateral, let's say, a simpler word, bilateral relationship. So, and this is where a new index compiled by Iacoviello and Tong comes in handy. So this is now AI-based, which is similar in spirit. So it's again reading newspaper articles, but it's now done through an algorithm, a machine learning algorithm. But what's important here at this point is only relative to the other measure, that now you also have a measure of bilateral geopolitical risk, and that is simply compiled by reading these newspapers and checking whether 2 countries at the same time pop up in the same article when geopolitical risk events are mentioned. And so this speaks arguably more closely to this issue of fragmentation, because you want to consider a dyadic relationship, 2 countries, say, or more. Yeah, and here, interestingly, you see now that the red line, again, the 12 months moving average, is now increasing more towards the end of the sample, now reaching actually levels which you haven't seen in this sample before. Not dramatically so, but this points towards this increase in geopolitical fragmentation, if you read the data in the way I suggest you can. Okay, and here is a third measure now, which is perhaps cruder, because here we're looking at actual interstate conflict, so outright war, you might say. This is compiled from the Uppsala database on conflict. And so here in red, you see in each year how many armed conflicts there are. And here again, towards the end of the sample, in particular last year, of course, you have this spike. So you could make a case that there's an increased number of interstate conflicts. Yeah? Although you could also look at this graph and say, there's always been interstate conflicts. Yeah? Now, against this background, the fourth measure is maybe the most compelling. So it's based, this is Fernandez Villaverde and co-authors. They estimate a VER and extract a common fragmentation factor. They also look at sub-factors. Here you get the aggregate factor. And that gives a very striking pattern in the sense that you have 3 episodes. So you have the Cold War period where fragmentation has been high. So this is this common factor extracted. So they throw in all sorts of variables into this VER, and then they extract this common component. And this measured in this way, you would conclude that fragmentation has been high during the Cold War. Unsurprisingly, then you have what we could call the end of history period when this comes down. And then interestingly, and I will get back to that, around 2007, 2008, things start to change. And you see now in this post-global financial crisis period, increasing levels of fragmentation. Actually, now at the end of this sample, you get to a level of fragmentation which you haven't seen before in this sample. So that's a bit the, what's it called, the paper, are we fragmented yet? And the answer here seems to be yes. Okay, so what's my reading of these indicators? So I think it is not super striking across all indicators, but you could say, the bulk of the evidence supports this notion that we see increasing fragmentation levels, and some indicators say even more so than during the Cold War. The precise timing differs across indicators, of course. So against this background, I'd ask, what do we know about the economic impact of this geoeconomic fragmentation? About I was less sophisticated in distinguishing shocks and fragmentation, so I lumped this together in what follows. So what do we know about this? And again, I think a main takeaway is the stagflationary nature of these events, the adverse effect on trade, and the spillover. So let me illustrate this with a couple of graphs. So this is from a paper which came just out in the JIE, Caldara and co-authors. They estimate a panel VER and identify, based on a recursive ordering, GPR shocks, and then you get a very clear-cut picture. GPR goes up in a country. That's, again, not the dyadic index, but the country-level index. And then you see inflation going up persistently and GDP going down. So that's your textbook supply shock. Yeah? Now, I have myself worked on this with Felipe and co-author. This is a paper which we just published in March in the AER, where the price of war, it's somewhat boldly entitled. So here we look at the last 150 years, and we look at what wars do in terms of the economy. Yeah? And we distinguish the war side, which you see here in purple. So these are just the impulse response to your average war. Yeah? And then you see it contracts output, that's in the war side. It pushes up prices, CPI, upper right panel. We also look into other belligerent countries. These are the yellow responses, yeah? And the black ones are the responses of third countries. Yeah? There you don't see much yet, yeah? But I want you to keep away, again, in support of this notion that we are talking here about a massive supply shock, that we see capital stock declining, that's the lower left panel, and we see also TFP declining. Yeah? So the archetypal supply shock, okay? Now, looking at trade, I want to mention this very influential paper, Gopinath et al. They document that they look at what happens across these blocks identified on the UN voting patterns, and then they look at what happens in terms of trade, yeah, across blocks, that's the left panel, and in the right panel, that's for the non-aligned, trade with non-aligned countries. Yeah? So this, and then they benchmark this against what happened at the beginning of the Cold War in 1947. Yeah? So that's the blue line, and then you have this intriguing game that you see, okay, when it comes to the cross-block trade, we are doing worse than after the start in the war in Ukraine, than with the start in the Cold War, but we do better when it comes to the better meaning more trade across blocks. Yeah. So we were talking AI. So I was, pushing my codex, to say, can we replicate this? I would have like added another two. It worked hard, but then the data was proprietary, and so I hit a wall. I gave up on this after 10 minutes. One gets impatient these days with these tools around. Yeah. So maybe somebody else can update this. Yeah. Okay. So that brings me to the spillovers. So this is again from our paper, Price of War, where we start off with this Trotsky quote, which we think is quite relevant to this day. Yeah? You may not be interested in war, but war is interested in you. And here we look at countries at war in a given year. So that's the purple line. Yeah, and the takeaways, there's always been war. We didn't always look at it. Yeah. But more importantly for this paper is, these spillovers, because we motivate is, there's so many adjacent countries to a war site in any year. Yeah. And if you just, based on this data, somewhat simplistic, admittedly, just compute the unconditional probability of becoming adjacent to a war site. So saying there is a probability that the war starts next door, then the probability in this annual panel, 150 years, is like 12%, so like 2 or 3 times the unconditional probability of suffering a financial crisis. Yeah? So I think that tells you this is really important, and that's also something central banker should take note. So if you're just exposed to a war next door. Okay, and then we estimate the effects of such a war taking place next door, and here we distinguish, and I think that's the maybe obvious result, but still we think important takeaway from this paper, that these spillovers depend on exposure, which we measure here through trade linkages. So in red you see the output response and the price response of a country which trades with the war site a lot, like 3% of its GDP is imports from the war site. So that's like, think Germany, France. Yeah, so that's a lot. So Germany, Ukraine, for instance, would be much less. Just to put this into perspective. So the trade linkages prior to the war do matter for the spillovers. Yeah, in black. So that's a hypothetical scenario with little trade to begin with. There's practically no spillover. So the spillovers only materialize to the extent that you're exposed via trade linkages. Okay. I should say in the Caldara paper, the JE paper, they also have nice spillover graphs, for the GPR shocks. So GPR shocks and outright war give you very similar patterns here. I want to also flag that currently with one of the co-authors from the Felipe paper, we are working on rationalizing this in a multi-country DSGE model, just to check whether, the current class of model can make sense of these spillovers. And you see here some impulse response matching exercise. This is still work in progress, but you can see that the model in principle is able to generate this pattern. And what the story which the model tells is a story of this spillovers of the stagflationary effect. So you have this supply side shock in the war side, and through trade linkages that spills over to the other countries because prices shoot up. I mean, in the model they shoot up. You could also think that there are some shortages, but in the model it's basically the price response which incentivizes or makes these supply side shock transmit across countries. Last, from a paper which is called The Proximity to War. This is like a case study of the war in Ukraine. Here we look at financial channels. So this is just looking at a window, a 2 weeks window around the start of the war in the Ukraine, and then comparing countries which are neighbors, that's the solid line, to a bunch of control countries. In the right panel, that's a synthetic control, but the pattern doesn't change much. You see just if you're adjacent to the war site, then financial markets respond differently, and we interpret this as they price in the risk that this military conflict escalates geographically. We also control for trade, and there remains something of this military spillover risk. Okay, so where do we stand? I think we understand that these shocks are stagflationary, they're bad for trade, they generate spillovers, and geography matters. What is less clear? to me, my reading of the literature here, I might miss something, of course, so this was quite a biased representation. So how much rerouting there is really going on, what's really the role of these connector countries? We need an update of the Gopinath paper, I think. So what role do supply chains really play and the production network globally? Does it buffer or amplify these spillovers? And then what is relevant here is how monetary policy should deal with the ensuing trade-offs in the face of these supply shocks. But the upshot is these fragmentation shocks are costly. So where do they come from? What's the take? And in the last part, I want to briefly mention, candidates for explaining this, and I think this also is again linked to trade. Yeah, there's a very influential and I think very fascinating paper by Mette and co-authors, Make Trade Not War, some 15 years ago, or almost 20 years ago, where they make a very simple but powerful point. They empirically and theoretically, they show that multilateral trade, if you trade a lot with other countries, that reduces the opportunity costs of war, the assumption being in the event of a war, trade shuts down between the warring parties. So if you trade a lot with other countries, the opportunity costs of going to war decline a lot. And so the more you trade with other countries, the more the risk of conflict escalating with a specific country increases. And then in more recent work, the same co-authors, also with Isabelle Michel, they make that point again and phrase it, I think, quite compellingly as a fragmentation paradox or security dilemma, right? Because we understand that immediate impulse in the face of higher geopolitical risk is to de-risk. We talked about this for a couple of years now. We want to diversify the supply chain. That's all fine, but the implication, if you're serious about this idea of opportunity costs of war, is that you raise conflict risk. So you make, in the event, conflict less bad because you're more diversified, but precisely because it lowers the opportunity costs, it makes a war less bad, and therefore more likely to happen in the logic of this setup. Okay, finally, I also want to highlight, I think, a point which we are developing with co-authors, and I think so let me try to make this point. So a lot of this discussion starts with Montesquieu and this liberal idea that peace would be the natural effect of trade. So, but if you think about it for a second, then you understand the logic cuts both ways, meaning that the same logic gives rise to two possibilities, a virtuous and a vicious circle. The virtuous circle is you get more trade, and therefore less risk of conflict, and that again is good for trade and so forth. And that's how you read Montesquieu at face value. But the logic also cuts the other way around. So if you enter a conflict, you have less trade, and the less trade you have, the more likely you are to have more conflict. So we put forward a simple model in Adolf et al., where we look at sourcing decisions of firms. And firms, when they make their sourcing decision, they anticipate the government's decision to let a conflict escalate. The decision of the government, in turn, depends on what firms have done in the first place. And if there's a lot of sourcing, then escalating becomes very costly. So you can see that there are a world with multiple equilibria. So you could have a benign equilibrium. So that would, let's call this the Montesquieu equilibrium, even though the logic Montesquieu cuts both ways, but that's maybe the first reading you have of Montesquieu. So a lot of trade fostering peace and peace fostering trade, and so forever a liberal paradigm, wonderful. But it can also operate the other way around. So we show this formally that you can go from conflict to less trade and from less trade to even more conflict. And we also put some evidence forward in support of this idea because we identified GPR shocks like many others in this literature. We estimate impulse response functions and then we distinguish whether these shocks are large or not. And if they're not large, then that's trade here. You see the response of bilateral trade flows. In blue, bilateral trade flows decline in response to a GPR shock, but then they recover after 4 years. If the shock's large, they never recover. Okay, so that's a pretty, I think, scary thought, but it's consistent with this Montesquieu model which we put forward, namely that you may end up in this bad equilibrium. So you shift from the good equilibrium to the bad equilibrium. This is this multiplicity which we built into the model. Okay, so but I think in concluding, I mean, the causality runs both ways. We look at geopolitical risks triggering this shock, so you may also ask, do we have large economic shocks which cause geopolitical fragmentation in the first place? And what comes to mind, I think, here is the global financial crisis. This was a big shock. Yeah. It lowered trade dramatically. We discussed this in the beginning, but actually, if you look at the data, trade hasn't recovered at all since the global financial crisis. And you may speculate to what extent the global financial crisis, being such a traumatic event, has fostered anti-globalization sentiment, protectionism, and so forth. So then the global financial crisis would be the economic shock which triggers geopolitical fragmentation. Here's the figure which you probably have seen, but let's pause for a second. So this is world trade relative to world output. You have the famous waves of globalization, but after the global financial crisis here, you see in blue that's goods trade, in red is services. But since the global financial crisis, we are also below pre-global financial crisis level when it comes to trade. Yeah, so in a way comparable to Great Depression, right? So that's another interesting parallel. After the Great Depression, we also saw this first wave of globalization coming to an end. So this would be the idea that you have these economic shocks which foster anti-globalization sentiment and lead to then geopolitical fragmentation. With this, I want to conclude. So what are the implications? So I think policy needs to confront this fragmentation paradox, this security dilemma, and I think I don't have good answers, so I just want to flag that issue here. De-risking supply chains, it sounds like a good idea, but that means a more lower opportunity costs of war, and in some sense then higher risk of bilateral conflict or across blocks, if you want. The good news here for you guys, I guess, is that this is, I guess, we shouldn't overdo it. This is not an issue for central banks to tackle. So what about monetary policy then? This is maybe jumping to conclusions, but it's a general agenda. I want to push it on any occasion. So I think monetary policy should not look through geoeconomic fragmentation shocks. Yeah, this has been argued at the ECB a lot. Yeah, and the argument was this is transitory. I think we should realize it's not transitory, so you should not look through it. Yeah, and more than ever, I think that's related to this last idea I put forward. Price stability is paramount to maintaining support for geoeconomic integration. Yeah, this cost of living crisis, I think, is really a bad thing in this context. So I think you could also derive a rationale for being serious about price stability mandates. Thank you.
Thank you so much for this very interesting and inspiring presentation. It made me think about that Francis Fukuyama and Samuel Huntington, just for the balance of it, should be integrated in the reading list of our economics students. Yeah. Right, over to you, Loretta, as our second speaker. The floor is yours.
Thank you very much, and thank you for all the organizers for, one, inviting me to speak, but also for the great conferences. Been great so far today, and I'll try not to bring the level down too much. So the last few years have been really challenging times for all central banks. And, if you think about the inflation shock, we hadn't seen that for 40 years to the levels. It moved up much faster, and it stayed high for a lot longer than central banks anticipated. And after the central banks took action, inflation did move back down. So that's a good thing. And it moved back down without a recession. But in the US, we haven't gotten back to our 2% inflation goal yet. So there's still a problem with inflation in the United States. And even before the latest energy price shock from the Iran war, people continue to feel the brunt of the higher prices that come with inflation because people's wages haven't moved up as much as prices. And we talked about that a little bit in the first session today about the level of prices as opposed to inflation. So this has driven many central banks to take a look at what went wrong, I would say, with policymaking during that high inflation episode. And the goal is always to improve your future performance. And I think this is a good thing to be doing, especially now, because I think there's a lot of structural changes taking place in the economy. And I think those structural changes are going to affect monetary policy making. And of course, one of these is the subject of this session, which is geoeconomic fragmentation. And I thought the first presenter did a really good job of laying out what the issues were. So I'm not going to belabor it too much. I'm going to show a few more charts that really try to argue that we have seen, you know, a change in at least the direction of things. So starting in the 1990s, we had this trend for more integration and increased global integration, and trade became more open, and that really brought a lot of benefits with it. More efficient production across countries because of comparative advantage and specialization and then scale economies, more intense competition that yielded higher innovation and more productivity, and then increases in the variety of goods that were available, which of course increases welfare. But I think one of the issues was that really not everyone benefited from, you know, when an economy transitions to more open trade and more liberal trades. And I think a failure to address, though, that, you know, which sectors were hurt versus winners, I think that's led to some skepticism among many people about really the well-established idea that there's benefits from more open trade. And what we have seen is that it has led countries to be really taking on more protectionism, and geopolitical tensions have risen. This is one of the indexes you saw already today. Trade restrictions are rising. A lot of different kinds of protectionist measures have been moving up. And I think what we've seen is, you know, as a result, we're seeing less integration and at least a leveling off. You know, many trade flows have become more concentrated, and many countries are sending a larger share of trade through a smaller group of trading partners. A growing share of existing corridors have either stagnated or have declining flows. And governments are really, and firms, I would add, are reassessing the risk and strategies, not only with respect to trade, but also in areas of finance, technology, and physical and cybersecurity. So there really is a change, I think, in tone and trend from rising geoeconomic integration to either stable or declining levels of integration. And I think that does have implications for the economy and therefore for monetary policy. If you think about rising fragmentation coupled with the other structural changes that are happening in the economy, I think policymaking is going to be complicated. It's going to be harder to forecast inflation accurately. It's going to be harder to forecast economic growth and employment, and I think it's going to make it much harder to really assess the stance of monetary policy because of some of the structural changes happening. And then that's going to also lead to a separate set of issues for central banks, in that the stability of the financial system, I think, which is needed to transmit monetary policy, is also going to be affected. So let me spend a little time just talking about each of those in turn. So first, with inflation, I think increasing fragmentation is likely to lead to larger and more frequent shocks to the supply side of the economy, certainly compared to the period of the Great Moderation. And that has implications for inflation. So despite what we talked about earlier today about monetary policy affecting the supply side, I think mainly it works to the demand side of the economy, helping to smooth out the business cycle fluctuations in demand around supply. And in that way, it promotes price stability and employment at levels consistent with price stability. So if you think back over the past couple of decades, I think assuming that the underlying structure of the economy was slow moving and that supply shocks were relatively infrequent and short-lived wasn't a bad assumption. And the standard view for monetary policy to look through supply shocks, since supply would likely realign with its longer run trend in relatively short order, and before monetary policy could actually have an impact, that was the right thing to do. But if you think about a world with increasing fragmentation, disruptions to supply are going to be more common, and they're likely to last longer. And to the extent that supply chains have become more concentrated, a given shock is likely to have larger effects, especially if it's a shock to a critical input into other goods. So assuming that supply is stable, I think, is no longer valid. And monetary policy is still going to aim to keep demand and supply in balance to constrain price pressures, but I think it's going to be more challenging to do because it's not just demand running, moving around because of shocks around supply that's stable. I think they're both going to be moving, and I think that's going to be an issue that's going to make it more complicated. If you think back when the economy reopened after the pandemic, the Fed was attributing much of the increase in inflation to supply shocks that we expected to be transitory. And I think what was missed was that demand was much stronger than we thought. The accommodating monetary policy was also coupled with very accommodating fiscal policy. And so demand was strengthening at the same time that supply was continuing to be constrained. And so there was a growing gap between demand and supply. And this picture just shows you the forecasting in 2021 and 2022 of the FOMC. I admit I was on there then, so this includes my failure to forecast as well. But what you'll see is that, you do these forecasts 4 times a year. We were moving up the inflation forecast, but we still never caught inflation. We were always under forecasting inflation. So it took time for the Fed to realize that the conditions for high inflation were in place, and that we really needed to be much more aggressive with monetary policy. It isn't clear to me that that lesson has totally been learned yet, at least in the United States, because until recently, if you listen to what the Fed was saying about the high tariffs and about the oil price shock, it really was centered on looking through it as a one-time price adjustment rather than identifying the factors that could lead to this a more rising and persistent imbalance between demand and supply, and therefore persistent inflation. But I do think there's some learning. And if you look at what the Fed is doing and other central banks, they're doing a lot more to monitor the supply side of the economy, supply conditions. They're incorporating those factors into their assessments of both inflation and economic activity. And I'm showing 2 here. The New York Fed publishes an index measuring pressures on global supply chains. A lot of central banks are including questions in their business surveys about, what's going on the supply side of the economy. And central banks are also doing things to distinguish the supply factors of influencing prices from the demand factors. The Board of Governors has started publishing a survey that takes the Beige Book, which is their survey before every FOMC meeting of business contacts, and then using AI to generate an index that really looks at sort of comments on the bottlenecks. They're looking at statements that the firms have made on that. So again, more monitoring I think is a good thing. Now, policies that are leading to increased fragmentation are also affecting the labor market. And in the US, we have very strict now immigration policies. That, coupled with the fact that our population is aging, has led to a noticeable drop in labor supply in the United States. So it used to be that if you wanted to measure what level of job growth is needed per month to keep the unemployment rate constant, that was about 155,000 jobs per month just a couple of years ago. Now it's estimated between 0 and 50,000 jobs per month. So that change in supply is going to make it more difficult for policymakers to assess the health of the labor market, which is part of our mandate in the United States, and then harder to assess whether labor market developments are adding to inflationary pressures. So again, much more difficult to really assess the condition of the economy. Of course, another thing that fragmentation and the structural changes that we're seeing in the U.S. Affect are the neutral interest rate, the R-star. Now it's much more uncertain than it was. Again, complicating monetary policy because we do, in a sense, even though R-star isn't visible, we still use the concept to really evaluate whether policy is accommodative or restrictive. And of course, R star is related to the potential growth rate of the economy, which is related, of course, to productivity growth. Before the pandemic, estimates of the longer run neutral rate, at least in advanced economies, had been declining for more than 2 decades because the population was aging, because there was a change in risk preferences and investor demand for safe assets had gone up, and there was slower productivity growth. But now, the low labor force growth due to immigration and demographics will continue to put downward pressure on R star, but there's also an offsetting thing going on in terms of technology, and productivity growth in the United States has gone up. Part of it, I think, was investment in technology when the labor market was really tight after the pandemic, but also it is AI. A lot of firms are now investing in it, they're adopting it. I think it's too soon to tell whether that investment is an increase in productivity growth is really going to be a one-time increase, or whether it's going to be a sustained increase in productivity growth that more than offsets the downward pressure from the slower growth in the labor market on the neutral rate. But I think it's something that's going to make it more difficult to do monetary policy. And of course, the other thing putting upward pressure, on the neutral rate is the rise in government spending in many countries, and the need to attract investment for that spending. And of course, some of that rise in spending is due to countries wanting to invest more in defense spending, and I think that you could very much attribute to increased fragmentation. And of course, the private sector also is investing in AI, digitalization, other technologies, and that could also put upward pressure on the neutral rate. So I think it's too soon to tell whether the neutral rate is going to be sustainably higher, but I think it may be rising. And again, that means that policymakers are going to have to reassess, right, what constitutes contractionary or expansionary policy. Now, in a world with rising geoeconomic tensions and more frequent shocks, we would expect to see more volatility. So understanding economic dynamics becomes, I think, increasingly important to policy decisions and communications. And, policymakers, I would say, and economists to a certain extent tend to think about shocks in isolation. So if you think about an impulse response function, we like to show the effect of a shock and then it dissipates over time. But if you think about a world where one shock hits, followed by another shock, the effects can be reinforcing and be amplified. And you think about, we had the post-pandemic supply shock, chain disruptions. Those were still in full force when we had the Russian invasion of Ukraine, raising energy prices. So we had sort of a series of shock, and that second shock exacerbated the first shock because energy was such a key input into other goods and services. Again, in the US, we haven't really gotten inflation back down to 2% goal. And then we have, on top of it now, we had the tariff shock from last year, and now we have the Iran oil price shock. So we've had a lot of shocks layered upon other shocks before we got back, right, to where we need to be on inflation. So, I think what you see over time is as production costs go up, one shock, another shock, future shocks, the firms have a greater incentive to try to raise their own prices to protect their margins. So, as prices continue to advance, then you get a feedback into inflation expectations, which become more fragile, which makes it even harder for policymakers. So again, this series of overlapping shocks, which I think goes higher probability when you have a fragmented geopolitical system, I think that raises the likelihood of spillovers from any initial shock to the underlying inflation rate. I mean, the other reason to think about dynamics, and you hear this in the conversation somewhat, is, the short-run impacts can be different than the long-run impacts. So what you might want to do changes over time because of the impact of the shock. So if you think about a reduction in trade openness, it's going to have a negative effect on the macroeconomy over the longer run. But in some industries and in some people, depending on the job classification, it may actually benefit them. So that's going to be harder for countries to deal with as well, this time difference in terms of the effects. I think AI is similar, right? In the US, they're talking about AI as being this disinflationary shock. But in the near term, if you look at the data, it's actually an inflationary shock right now because there are bottlenecks and there's a huge demand for certain factors that go into the AI. So again, the timing of these effects matters and dynamics become more important. I think financial stability is also something we should be thinking about. If you think about even if you want to just focus on monetary policy, it is important to the transmission mechanism. And you could argue that increasing globalization of financial markets might lead to more opportunities for contagion of a shock across markets. But I think globalization also offers safety valves that can mitigate the risk of contagion and thereby lower the risk premium. So if you think about foreign exchange adjustments, central bank swap lines, the ability to diversify investment and move payments across countries, I think they help lessen stress, and therefore the economic impact of shocks on banks, the financial system, and the macroeconomy may be less. But increased fragmentation probably makes those safety valves impeded a bit. And so it may make coordinated action when it's necessary across countries much more difficult. So I think this is now another area where central banks have to take on another job of more careful monitoring, because now there's risks that stem from geopolitical tensions really have to be thought through. We can't depend on coordinated action to address some of the issues that are going to affect the financial system. So in my remaining time, I'm just going to conclude by offering a few recommendations for monetary policymakers when the economic landscape is more fragmented, volatile, and geopolitically uncertain. So first, I think policymakers have to acknowledge the uncertainty and just be more nimble with their policy actions. They have to be more willing and prepared to change policy if the economy shows salient signs that it's evolving differently than anticipated. And that assessment needs to consider not just changes in demand, but also those changes in supply and the underlying structure of the economy, because it's really demand relative to supply that matters, and that can be changing over time. Second, I think policymakers need to be less focused on the most likely outcome and more fully incorporate scenario planning and analysis into their framework for making monetary policy. But they have to do, and this is the complicated part, they have to do so in a way that maintains systematic policymaking. So if you just look at the most likely path, I don't think that's sufficient when there's a lot of uncertainty, and I think geopolitical uncertainty I include in there, more fragmentation, because the economy, as we've seen, can really evolve in an unanticipated way. And alternative scenarios can be almost as likely as the modal outlook. So I think it really deserves attention from policymakers. But you also want policy to be robust. And rather than setting policy to be optimal if the most likely scenario comes to pass, you want to set policy so that it really minimizes the losses if the economy evolves in a less desirable way. And so, policymakers like to talk about policy being well-positioned. I think robustness is a pretty good way of thinking about what well-positioned means. I think to be nimble and flexible is valuable, but I think the flexibility has to be disciplined. And what I think is that really you don't want to have policymakers looking at a bunch of different scenarios, and then even if that second scenario isn't coming to fruition, they then start talking about that scenario as being the one because it supports whatever policy action they want to take. So we want systematic and not discretionary policy. So if you think about it in terms of the reaction function, we kind of want the coefficients to be relatively stable, but we want the inputs into there to reflect the potential paths the economy could take. And I think doing this kind of disciplined scenario planning really will lead to more nimble policymakers, because the policymakers will have thought through what appropriate policy will be in those cases. And then my third recommendation basically is, I personally think that in an uncertain world, policymakers should be communicating more, not less. But I think they need to do it in an effective way. And I think the effective way is not necessarily forward guidance, but really explaining what they think the outlook looks like, what are the chief risks and uncertainties, so in other words, some of those other scenarios that could come to play, and how, right, that then would then influence policy. So reaction function as opposed to explicit telling the path of policy. No, tell us the thought process, the reaction function that goes behind making the policy. So I always like to say how policies like to react conditional on how the economy evolves, not regardless of how the economy evolves. And I think that principle should guide sort of how they discuss policy decisions in the future. And I think that's a better way of doing it, because we've had examples where if the economy evolves in an unexpected way, right, policymakers are faced with this really hard trade-off, whereas they either delay doing what is probably the right thing to be doing, or they renege, right, on something that they were perceived as promising. So you don't want to have that happening. You want policymakers to basically explain things well enough that when the economy starts moving in a direction that wasn't the most likely direction, right, they can take the action that's necessary and not feel that they're reneging on something that they had said before. So with that, I'll finish. Thanks.
Thank you so much, Loretta. I mean, you're not only a distinguished academic, you're also the former president and CEO of the Federal Reserve Bank of Cleveland. So your insights on how we become more nimble and flexible, and at the same time maintaining clarity and credibility, very much appreciated, but it's not an easy task for sure. Luis, you have the pleasure of being our first speaker, so I will kindly give the floor to you.
Thank you very much. First, thank you very much to our organizers for inviting me to this panel, to CEBRA, the National Bank of Denmark, and University of Copenhagen. Let me start, all the disclaimers are applied there, so you know. Okay, let me start talking about the current state of global economic integration. I don't know if I have to say current state, but let's say the current state of global economic integration. First, we observe networks of linkages across countries have become more complex. Second, supply chain have become highly internationalized, and the production of many commodities, critical commodities, have become highly concentrated. So the previous panelists talk significantly about this. I'm going to show you just one graph that shows that there are some critical commodities there that are concentrated. This is going to be important for my remarks, given that I'm the emerging market guy in the panel. Okay, so we have that the integration has been significant. Specialization has been there. We have all the different measures. If you think about emerging markets economies, it's even more clear. Our integration, the contribution to the world trade openness by emerging markets economies has been increasing. And also the country links to global value chain has been increasing. So for emerging market economies, this process is a process in which we have been relative significant actors. So it's important for emerging markets economies what is happening in the world. Foreign direct investment has also been a significant part of the story in emerging market economies. You can see by the graphs immediately that FDI restrictiveness has been decreasing in many countries. We have seen a significant increase in FDI. And this is going to be important because FDI in many of emerging market economies is linked directly to technology absorption. So productivity growth is also there. Now, if we have to define the current situation, interdependence, or if some of you want to say, want to be negative, the past state of affairs, but let's say the current state of affairs is interdependence. Let's go. Okay, so now one point that I want to make here is that geopolitical factors have always been part of the discussion, have always been present. Let's talk about the origin of the current state of affairs. So the end of the foreign official convertibility of the US into gold, dollars into gold, is what generates floating exchange rate system all over the world. It generated the European Union and the Euro, all the incentives were there. US-China policy in the 70s, as a response to the Soviet bloc, generate globalization in trade and the rise of China. So it's linked, you can link all these outcomes to geopolitical dimensions. Now, flexible exchange rate, independent monetary policy, and capital mobility were basically linked to the dollar dominance. When the US decided not to have a policy in capital controls, was playing a critical, or were implementing a critical element for the internationalization of the dollar dominance. So, the tendency of free market economics also was motivated by political influence by the US to the rest of the world. So, geopolitics factor has been a factor always. What is critical, I think, and there's a fantastic paper to Clayton Majori and Traeger that is also linked to Professor Müller's presentation, is that hegemonic power so far have implemented their power in a way with some sort of a constraint. So you can see international institutions as commitment device. You were willing to use the power that you have in order to increase your welfare, but with this commitment device, constraint or credibly constrained to the use of coercion, generate the current state of affairs. So this is the equilibrium that we have so far. But clearly, we have seen, as the previous panelists show, that geopolitical tensions have increased significantly. I'm going to skip all this. You have all the graph in the previous presentation. So the question is, if we are moving to a new equilibrium, an equilibrium in which the different countries understand, or at least perceive, the willingness of the hegemonic power to use that power. So if that is the case, maybe you will respond. And if you respond, then we can have, through, for example, the risk in block formation and industrial policy in more in general terms, then you can have an equilibrium with fragmentation. You can tell sort of a story like you were mentioning on multiplicity of equilibrium. Imagine that you have some fixed cost to respond. At some point, the cost that you're perceiving is too high. Maybe you're going to be willing to pay that fixed cost, and then you're going to move in a different trend. So it's sort of a multiplicity of equilibrium story, or moving to another equilibrium is there. So I think that fragmentation can be an equilibrium nowadays. And then you have all the signs of fragmentation. Some of them were discussed before by the previous panelists, so I'm going to skip them. So signs of fragmentation are there. Now, in terms of economic fragmentation cost, every report, your work, Professor Müller, and all shows that fragmentation costs in trade, the trade fragmentation costs are very significant. So we're talking about values, 9% of GDP, 6% of GDP, 3% of GDP, different figures. But fragmentation is costly in terms of GDP, is costly in terms of welfare. And sometimes we forget that globalization and economic integration generate significant benefits in many, many societies. That doesn't mean that we don't have to take into account where the costs or the missing dimensions that we as policymakers have. But I think it's fair to say that globalization generate benefits. It's a different thing how the different social contracts work with those costs. Financial fragmentation is very costly. Geopolitical tension can increase the costs for banks. Banks in many of emerging markets economies are the main source of credit, can generate adverse effects in economic activity. The reduction also in risk diversification can be also significant, okay? And one of the things that we know from international economics is that the risk diversification is very significant. It's very important for economies that are hit by different shocks. That sharing of risk sharing is extremely important in terms of welfare. So here we're talking about a significant consequence in terms of welfare. And I already mentioned that technology absorption can also be hurt significantly. And if you think in terms of emerging market economies, again, most of the technology absorption comes through FDI. And that can generate additionally more innovation in economies. That is basically what we try to do, to absorb technology. If you're far away from the technological frontier, you absorb technology and then you start trying to move closer to the global technological frontier. So that is another potential cause in this case. One mention regarding the global payment system. There was some mention of the global payment system in the previous panel. There's also something that we should take into account. There's a couple of papers by Paul Krugman in which what determines the structure of exchange is a distribution of transaction costs across currencies. And this is linked, if those costs are perceived as increasing, then dollar dominance can be put into risk. And with the new technologies, this also is something that at least should be taken into account. Now, what are the perspectives for emerging market economics? I already mentioned, there are some countries there that have some benefits in the sense that there are countries that are critical in the supply of some minerals, critical minerals, that is going to be part of the game. And this is particularly in Latin America. I'm talking about, for example, copper and lithium. But the point that every one of you, I'm sure, has in their head is that the fragmentation is going to fuel larger and more frequent supply shocks. The evidence that was presented before indicates that we're going to have, when you have a geopolitical shock, you have increases in inflation, decreases in output. One thing for the participant of this conference, I think that the identification of transmission shocks is going to be crucial. So I have seen the papers that are going to be presented here. There's very wonderful papers about the input-output, the network effects. All those papers are going to be super important in order to understand what can be those links that are more critical for different economies, not only for emerging market economies, it's to identify those choke points. Now, I think that the message for central banks will be to enhance the monitoring of supply chains. We need to understand better what are those connections. Macro model with supply chain interlinkages are going to be, I think, part of the menu for different central banks, because you have to understand what are, in a fragmented world, what are those connections. And this is particularly important because central banks typically talk about look-through supply shocks. But in order to look through supply shocks, you have to understand what the consequences of those supply shocks are going to have in inflation dynamics. If you don't have a clear understanding of that dimension, then you're going to have a problem with inflation expectations at some point. Now, coming from an emerging market economy that has implemented a sound macroeconomic policy, I have to say, one thing that I think is going to be super critical is going to be to have a credible inflation targeting regime. And one dimension that I think is important here. In Chile, we implement an inflation targeting regime that is basically a flexible inflation targeting regime. So you say we're going to bring inflation to 3% within the monetary policy horizon. And let me talk about the monetary policy horizon. In many IT countries, you have monetary policy horizons. In our case, it's 3 years. I think that if we're thinking that we'll have more supply shocks, then I think that some central banks are going to need to start thinking about a monetary policy horizon. If you have a large supply shock and you basically don't give any clue to market participants regarding when inflation is going to come back to the target, maybe you can have some issues with inflation expectations. So I think that if this fragmentation is a new order, maybe some adjustment in monetary policy frameworks are going to have to be implemented. Second, symmetric response of monetary policy, okay? So if you have a positive shock, then or increase in inflation, you're going to bring inflation back to the target, trying to reduce any impact on economic activity. But the other way around also has to be true. Otherwise, you're going to have a bias. And if you have a bias, you're going to have an issue with inflation expectations. Second, or a third element, or second element in my description, international liquidity is going to be extremely important to build adequate buffers. And here I think there's going to be an issue. There is a general issue. The first panel, you talk about this, is international reserves. So if some of the portfolio assets that in which you were investing are changing because of fragmentation, then those portfolio assets are going to change. So you're going to have to ask yourself, in this new scenario, what is the optimal portfolio in terms of international reserves, given the potential equilibrium that we're going to have? Our treasuries are going to remain with the same characteristic in terms of payoffs or not? So that's the type of question that many central banks are going to have to be talking about. Financial stability regulation is also going to be super crucial. Loretta will talk about this. Today we were thinking about, or there was a question about macro-prudential policy. There's always going to be a trade-off, no? If you implement macro-pru, you're going to have, in some cases, you can have less credit. It's going to depend on the capital of the banks and all that. But you also have to take into account the issue that you are implementing that macro-pru because there is some externality there that you have to take into account. So there is no clear cut for that. Now, critical identification of vulnerabilities and potential structural changes in the economy are going to be all over the place if this scenario it becomes reality. Now, I think that what many central banks, including the Central Bank of Denmark, has been doing is fantastic. Microdata is going to be crucial. It's going to be crucial to understand the supply chain. It's going to be crucial to understand the choke points. It's going to be crucial to understand what are the potential changes in the structural parameters of the economy. So I think that it's going to be needed for many central banks to foster the generation of microdata, because I think it's going to be super important. Particularly, we start thinking about input-output and network models. I mean, it's going to be there. Also, to think about the microstructure of good markets. There is a very good paper that is going to be presented on Wednesday by a young economist here, Jorge Miranda, about firm-to-firm relationships and how characteristic of that trading can affect price rigidity, can affect the markups. That is also going to be important because if we're thinking about the transmission of monetary policy, that the slope of the Phillips curve that is going to be affected by these factors can change dramatically. So the transmission of monetary policy can change. So we need better models. We need, to improve our models or to consider the dimensions, we need better micro data. With that, I think, last point. All of this is happening in a moment in which technology has been changing dramatically. And I think that is a connection. I think that you were trying to make that connection in terms of labor market, technology, and the probability of observing more fragmentation. And I think that here we have a significant challenge. Political dimension can be affected by what's happening in labor markets, what can happen with automation and AI. So I think that also we need to have a critical understanding of labor market dynamics in order to have better responses. Here I just show that globalization was associated with positive increase in labor market or positive increase in employment. So you have increases in employment with globalization. In a near equilibrium, political challenges can be super significant. And the last point, transition costs can be significant. So it is extremely, extremely important to have our economies in a good balance. Initial conditions are always, always, always super important when you face shocks. If you have an economy in equilibrium, you're going to be better prepared to face different shocks. So I think that robust policy in this case will be to try to come up with or to try to have your economy in an initial condition that is giving you the best potential response to negative shocks. And that means coming back, having a credible inflation targeted regime or credible monetary policy regime, and also a monetary policy horizon that anchors inflation expectations. Thank you.